As the Ukraine war enters its third month, analysts are forecasting a prolonged conflict. Russia's invasion has upturned Europe's energy strategy and slowed the growth outlook worldwide as China's COVID lockdowns add to supply chain disruptions. Faced with these uncertainties, Lombard Odier Private Bank is exercising caution in its macroeconomic and its investment outlook, and its Chief Investment Officer, Stéphane Monnier, joins us now. Thank you so much for being with us today. Now, Lombard Odier is keeping a prudent portfolio, underweight allocations to fixed income, neutral exposure to equities, and overweights in cash and commodities. How has the fall in bonds and equities really challenged traditional diversification strategies?
Thank you very much, Ramia, for having me and for your question. Indeed, the start of the year has been difficult with both fixed income and equity markets underperforming. The thing that was important for us at Lombard Odier was to build portfolios that will be able to deliver an asymmetric risk profile to our clients through diversification, but also through option strategies.
In terms of equities, you are highly exposed to UK value, energy, and healthcare segments. You've also raised your exposure to US equities. Why the US, and in what US segments are you investing?
Thank you very much. The reason why we are investing in the US market, this is the market which is the most resilient in terms of when there is a recession or a financial crisis. And also, this is the market which is the more immune to the current conflict in Ukraine. And in terms of sectors, our preference goes to energy, goes to materials, but also to domestic financials in the US. And we have generally a very favorable outlook for the healthcare segment.
Now, Lombard Odier has overweight holdings in a basket of commodities, EU real estate, and a large cash buffer. Which commodities and which real estate opportunities in particular are safe and potentially lucrative right now?
For the commodities, our preference goes to industrial metals. Like metals like copper are very interesting because with the climate transition that we will be experiencing, there's going to be a high demand in copper. But we also have exposure to energy commodities and also to precious metals such as gold. In terms of real estate, our preference goes to European real estate, and the segments that we prefer and we find the most lucrative are residential and logistics in Europe, because in those sectors, the rents are very often indexed onto inflation, which will be favorable in a higher inflation regime.
And which countries in Europe in particular, sir?
We like most of the countries. We will clearly avoid Eastern European countries because of the conflict in Ukraine. And also, we think that Germany and Italy could be more affected by the increase in price of energy. So we will try to avoid also those two.
And how should investors think about equities in this inflationary and this rising rate environment? I mean, are the negative drivers already incorporated into the outlook right now?
Yes, indeed. The inflation, the fact there is inflation is already incorporated in most markets. We have been conducted some studies on the previous periods of inflation, and we have found that both value and quality companies are the ones that outperform at times of inflation. We prefer companies that have pricing power. We prefer companies that have strong balance sheet and companies that can generate a lot of cash flows. These are the companies that outperform at time of inflation. Inflation is not necessarily a bad thing for equities. If inflation stays, in a range of 2 to 4%, this is actually positive for equities. But when it's much higher, and you know that currently US CPI is at 8.5%, this becomes unfavorable for equities. And that's why we have also created some option strategies to protect our client portfolios on the downside through put spreads.
So that is reassuring in some ways. Now, Lombard Odier expects the Ukraine war to cut between 0.5% and 1% from global GDP this year. Tell us your rationale behind this forecast.
But there are several ideas behind this forecast. The first one is that a higher price of energy impact the consumer because the money that is spent on buying energy is not spent on other things. Second, the crisis in Ukraine creates disruption in trades because, as you know, for example, planes or ship cannot travel through that region. So that's a second reason. Then there is a big impact on the consumer sentiment. You know, at time of war, people are more prudent and they try to reduce their spending and maybe save more money for more difficult times. These are the three main reasons why we have reduced our forecast, as you said, between 0.5 and 1% of GDP for the world economy.
Thanks so much for your insights today.
Thank you very much.